Myth 1. Keeping cash is the safe option. The logic sounds solid. Cash doesn't crash. It doesn't disappear in a bad market. You know exactly how much you have, and it's right there whenever you need it. Safe, simple, stress-free. But here is what nobody mentions when they say that. Inflation doesn't care that you feel safe. It keeps moving whether you're paying attention or not. If prices rise 3% a year and your cash is sitting still, your $10,000 is doing the financial equivalent of standing on a treadmill. The number stays the same, but the ground underneath it keeps shifting. Run that forward 10 years, and that same pile of cash has lost somewhere between 20 and 30% of what it can actually buy. You didn't make a single bad decision. You didn't invest in anything risky. You just left it alone. And that was the mistake. The uncomfortable truth is that holding cash long-term isn't the cautious move. It's the guaranteed loss move. The only question is whether you lose to market volatility or whether you lose slowly and quietly to inflation. At least one of those losses is certain. Cash has a job: short-term needs, emergencies, things you'll spend in the next few months. Beyond that, it's not safety. It's just a slower way to fall behind. Myth 2. Always max out your retirement account first. This one gets repeated constantly. Max out your contributions. Get that tax advantage. Future you will thank you. And retirement accounts are genuinely powerful. Tax-deferred growth, decades of compounding, employer matching, all of it is real and valuable. But the advice stops making sense the second you have high-interest debt. Think about what's actually happening. Your retirement account might average 7 or 8% returns in a good year. Your credit card is charging you 22% interest right now. Every dollar you send to your retirement account instead of that debt is costing you the difference. That's not building wealth. That's building one pile while another pile burns. The smarter order isn't complicated. First, grab your employer match if you have one. That's an instant 100% return. Second, clear the high-interest debt. Third, build a cash buffer so one unexpected expense doesn't put you right back in debt. Then, once those 3 things are handled, pour into retirement accounts as aggressively as you want. The goal isn't to follow a rule. The goal is to make your money work as efficiently as possible. And sometimes that means ignoring the standard advice until your specific situation actually calls for it.
Myth 3. Gold is the safest investment. When everything goes wrong, markets crash, economies wobble, uncertainty spreads, people always say the same thing: gold. Buy gold. It's been valuable for thousands of years. It'll be valuable forever. Nothing is safer. And gold does have a genuine history. It's held value across civilizations, currencies, and collapses. The appeal isn't irrational. But the idea that it's some perfectly stable and reliable wealth protector doesn't hold up when you look at the actual numbers. Gold is significantly more volatile than most people realize. It can spike hard during a panic and drop just as hard when the panic fades. There was a 4-year stretch where gold lost nearly half its value while the broader market was recovering. That's not a safe haven. That's just a different kind of risk with a better story attached. The other issue is that gold produces nothing. No dividends, no income, no earnings growth. You're purely betting that someone will pay you more for it later. Stocks, by contrast, represent ownership in businesses that are actually generating revenue and profit. The long-term data on which one builds more wealth isn't even close. Gold belongs in a portfolio as a small hedge, a little protection against inflation or currency problems. It's not a strategy on its own, and it's definitely not the safest thing in the room.
Myth 4. A car is an investment. People say this one with complete confidence. I'm not just buying a car, I'm investing in reliable transportation. I need a dependable vehicle for work, so it's basically an investment in my career. And yes, you need a car. Yes, it gets you to work. But calling it an investment doesn't make it one. The moment that car leaves the forecourt, it starts losing value. Not slowly, fast. A brand new vehicle can lose a fifth of its value in the first 12 months alone. The asset you invested in is worth significantly less than what you paid for it before you've even made the first payment. After that, it keeps declining. Maintenance costs come up, parts wear out, insurance continues, registration continues, fuel continues. Every single one of those is money leaving.
none of it returns. That's not how investments work. Investments put money back in your direction. A car just requests more of it, consistently, until you eventually sell it for a fraction of what you originally handed over. A necessary expense is not the same thing as an investment. Buy what you need. Keep it reliable. Don't spend more than the job requires. And stop calling it something it isn't, because the language matters when you're making decisions about money.
Myth 5. Crypto is the future. Get in now or miss out forever. The pitch is irresistible. This is the financial revolution. The old system is broken. Early adopters become millionaires. If you're not buying now, you'll spend the rest of your life wishing you had. And some people did get rich. Early adopters who timed things right, people who got lucky and had the sense to sell, they exist. But the full picture looks different. For every person who turned a small amount into a life-changing sum, there are many more who bought near the peak, held through the crash, and ended up with a fraction of what they started with. The success stories travel. The losses don't. The volatility alone should give anyone pause. Prices can move 20% in a single day, up or down, based on a social media post, a regulatory announcement, or simply market sentiment shifting. That's not how currencies behave. That's how speculation behaves. Real-world adoption as actual currency remains limited. Most businesses don't accept it. Transaction costs can be high. It works better as a trading asset than as money. That doesn't mean the underlying technology has no future. It might. But there is a difference between an interesting technology and a reliable investment. If you're allocating money to crypto, treat it as the high-risk speculative position it actually is, not as the inevitable financial revolution that guarantees returns.
Myth 6. You need a financial advisor to start investing. Investing sounds complicated. Allocation, rebalancing, tax efficiency, risk profiling. There's a whole language designed to make regular people feel like they need expert help to navigate it. The financial industry has done an excellent job of making itself seem more necessary than it usually is. Here's what they don't make as obvious. For most people saving for retirement, building long-term wealth, trying to grow their money steadily over time, investing is genuinely straightforward. A single broad index fund, or ETF, gives you exposure to hundreds of companies instantly, at very low cost, with no daily decisions to make. A target date fund handles automatic rebalancing as you get older. You set it up once and leave it alone. The cost of hiring someone to do this for you is real and compounding. A management fee of 1 or 2% per year sounds modest, but applied to a growing portfolio over 30 years, it represents a significant portion of your final wealth transferred to someone else for something you could largely do yourself. Financial advisors earn their value in specific situations: complex tax planning, estate structuring, business transitions, managing significant wealth across multiple accounts. For straightforward retirement investing, the main thing you need is a brokerage account and the discipline to contribute regularly. Nobody needs to charge you a percentage to do that.
Myth 7. You need money to make money. This one is the great excuse. I'll start investing when I've saved up more. I'll get started once I actually have something meaningful to put in. You need money to make money. So what's the point right now? The point is time. That's the entire point. Compound growth is not particularly impressed by large sums of money. What it responds to is duration. A small amount invested early will, over a long enough period, substantially outgrow a larger amount invested later. The tools now make the starting amount almost irrelevant. Fractional shares mean you don't need hundreds of dollars to buy into a company. You can own a slice of almost anything for a few dollars. Platforms have dropped minimum investment requirements to essentially nothing. If you invest a modest amount every single month, starting in your 20s, the power of compounding over 40 years does something that feels almost unreasonable when you look at it. If you wait until your income is high enough or your savings are substantial enough, you lose the one advantage that money can never buy back. The person who started small and early almost always ends up ahead of the person who started big and late. The amount is not the constraint. The habit is. Start with whatever you have.
Myth 8. You need a credit card to build credit. The standard advice the moment you turn 18: get a credit card, build your credit history. Without it, you'll have no score, and no score means no loan, no mortgage, no financial life. So go get a card. Responsibly, of course, and start building.
Credit cards are one way to build credit. One, not the only one. And for a lot of people, especially younger people who haven't yet developed the discipline to pay the full balance every month, handing them a credit card and calling it financial education is setting a trap. Rent payments, which most people are already making, can now be reported to credit bureaus through various rent reporting services. A credit builder loan builds history without requiring you to borrow spendable money. Being added as an authorized user on a parent or partner's card can transfer their positive history to your report. The goal is credit history, not credit card ownership. Those are two different things. Understand what actually builds the score: consistent on-time payments, low utilization, account age, and you'll realize there are multiple paths in. The credit card is just the one they advertise most.
Myth 9. Renting is throwing money away. Classic advice, usually delivered by a homeowning relative. Every rent payment you make is making someone else rich. At least when you buy, you're building something. Ownership is always better than renting. The longer you wait to buy, the more you're wasting. What this completely ignores is everything that sits on top of a mortgage payment. Property taxes, every year, indefinitely. Home insurance, maintenance, and the average homeowner spends more on repairs and upkeep than most people budget for. A major repair, roof, heating system, foundations, can arrive without warning and run to tens of thousands of dollars. When you rent, that call goes to the landlord. When you own, it goes to your bank account. There's also the down payment to consider, a significant sum of money that, instead of being locked into a property, could have been invested and compounding for years. In many markets and over certain time horizons, renting and investing the difference has historically outperformed buying outright when you factor in all the carrying costs. Buying a home makes clear financial sense in the right circumstances: stable location, long time horizon, favorable market conditions. But renting isn't financial failure. It's a deliberate choice that, in the right situation, preserves flexibility and liquidity that homeownership costs you. The math depends entirely on where you are, how long you're staying, and what you do with the money you're not putting into a deposit.
Myth 10. You can learn to time the market. Sell before the crash. Buy back in at the bottom. Repeat. It sounds so obvious when the logic is laid out. Surely if you watch the signals carefully enough, read the right analysis, stay ahead of the news, you can figure out when to move. You can't. And here's the uncomfortable part. Neither can the professionals who do this full time, with teams of analysts and billions in resources. The evidence on active management consistently shows that most professionally managed funds underperform simple passive index investing over long periods. If they can't do it reliably, the idea that an individual investor can is not well supported. The specific cost of trying is measurable. Missing a small number of the market's best single days over a long investment period, days that tend to cluster right after the worst drops, dramatically reduces total returns. The investor who panic sells during a crash, planning to buy back in when things stabilize, often misses the sharpest part of the recovery while locked out on the sidelines. The thing that actually works is also the most boring thing. Invest regularly. Invest the same amount whether the market is up or down. Don't check it too often. Let it compound. It requires no skill, no prediction, and no timing. Just patience, which turns out to be the rarest thing in investing.
Myth 11. Paying off your mortgage early is always smart. Being debt-free is the dream. No monthly obligation, no interest payments. You own your home outright. The emotional appeal is completely understandable, and for a lot of people, that peace of mind is genuinely worth something. But the financial logic depends entirely on the numbers in your specific situation. If your mortgage interest rate is low, and the money you'd use to make extra payments could instead be invested in something generating higher returns, you are mathematically leaving money on the table every time you choose the mortgage over the investment. Every extra payment toward a low-rate mortgage is a dollar not compounding in the market over the same 30-year horizon. Over time, that gap can be substantial. The money you saved in interest is smaller than the growth you sacrificed by not investing it. There are situations where paying early makes sense. High interest rates make it more compelling.
Being close to retirement shifts the priorities. And sometimes the certainty and simplicity of being debt-free is worth more to a person than the theoretical returns they might have earned. That's a valid choice. Just make it deliberately, having run the actual numbers, not because it sounds like the responsible thing to do.
Myth 12. Student loans are good debt because education pays off. You were told this when you were 18. Education is an investment. Student loans are good debt because they pay dividends for decades in the form of a better career, higher salary, more opportunity. Sign here. And the logic isn't entirely wrong. Education can absolutely pay off. The issue is that this framing treats all degrees from all institutions at all price points as equivalent, and they are not. A practical degree from a reasonably priced institution leading into a field with genuine demand and competitive salaries, that can work. The debt is manageable relative to the income it produces. A very expensive degree in a field with limited job openings and modest starting salaries, that math often doesn't work. And the consequences are serious. Student debt doesn't disappear in bankruptcy. It follows you. Missed payments damage credit. Default has lasting consequences. You can find yourself a decade into your career still making payments on an education that didn't produce what it promised. The question was never, is education worth it? The question was always, is this specific education at this specific cost worth it given what I'm likely to earn?